Hello, welcome to the Chapter 13 lecture where we're going to be talking about corporations. In Accounting 1, we saw everything from the perspective of a sole proprietorship. We looked at a service company, we looked at a merchandising company, but again, all from the perspective of a sole proprietorship. In the most recent chapter, we looked at things from the perspective of a partnership. From this chapter going forward, everything that we look at will be from the perspective of a corporation. Now, the accounting cycle is essentially the same for a sole proprietorship versus a corporation, but we are going to see major changes in the stockholders' equity section. So there are a lot of things that will change in this section as we talk about corporations. So let's get started. So a corporation is sometimes referred to as a separate person because it is a separate entity that is created by law. It can sue, it can be sued. It continues separate and apart from its owners. You know, with a partnership, if one of the partners happened to die or happened to leave the partnership, then the business had to end immediately and it could be reorganized with new partners. Well, with a corporation, ownership changes hands easily. One owner can easily sell his or her share of ownership to someone else and the business continues. So its existence is separate from its owners. It does have certain rights and privileges. That's why I said it can sue. It can be sued. The ownership can be privately held or publicly held. When the ownership is publicly held, the company has its units of ownership, which are referred to as shares of stock. Those units of ownership are traded or exchanged on a public exchange market like the New York Stock Exchange. It's a member of the Dow Jones or NASDAQ. That's what we see when a company is publicly held. When a company is privately held, it is still a corporation. It's just that the units of ownership are not publicly traded on an actual exchange. It's not listed on the US Stock Exchange. So, for an example of a publicly held company, McDonald's, Walmart, Tesla, all of those fall into the category of a publicly held company. For a privately held company, I like to use Burger King, but Burger King has been public, it's been private, it's gone dark, back and forth, back and forth. And when I say go dark, I mean a company that was once public has decided to go back private. But Wawa, Chick-fil-A, those are companies, widely recognized that we all kind of know and see. But as individuals, we can't own those companies because the units of ownership are privately held. Now, I mentioned, let me go back for a second because it is an entity that is created by law. And I wanted to highlight that for a second because every state has different laws as it relates to corporations. Some states, their laws are more advantageous to corporations. So you'll find that a lot of the big companies are incorporated in those states. For example, Delaware. Large companies like Disney, there are tons of companies that are incorporated in Delaware because the corporation laws are advantageous for those businesses. So there are many advantages of a corporation. Yeah, I mentioned that ownership changes hands easily. So that transferability by one owner selling his or her share of stock to someone else makes it easier for the corporation to raise money. So when you see down here, easier capital accumulation, I'm talking about the corporation itself raising money. I know you're thinking, well, what do you mean? When new people come into the business as owners, all the business has to do is issue additional shares of stock in order for them to do that. And when those individuals purchase the stock, they give the money to the company itself. Now, yes, it goes through brokers and all those different things, but ultimately, when there is a new issue of shares of stock, the money goes to the corporation, and the corporation can use the money to purchase property, plant, and equipment. They can invest in themselves, buy buildings, things of that nature, hopefully to make themselves more efficient. So there is that ease of raising money in a corporation. Whereas for a partnership or a sole proprietorship, if you want to raise money, you actually have to give up a portion of your business. And when you do that, you're sacrificing control, especially with a partnership. Other advantages, again, corporation is a separate legal entity. It can sue, it can be sued. And because it is a separate legal entity, it also enjoys limited liability, which means that the owners of the corporation are only liable for their share of ownership. If the corporation dissolves or it ends and there's debt still on the books, to satisfy the debt, the creditor can't go to the homes of those shareholders and take those personal assets of those shareholders. Those shareholders or owners of the company are only liable for what they have invested in that company. Corporation does have a continuous life, and there is no mutual agency for stockholders. And we learned about mutual agency in chapter 12 and looking at partnerships. And that's when one partner can bind the partnership on behalf of the other partners in an agreement, as long as it is within the normal course of business for that partnership. Well, for corporations, that doesn't exist. So if I purchase a share of stock in McDonald's and I own a piece of McDonald's, I can't go to Hustleman down the street and decide that, okay, my local McDonald's is going to get all of its meat from Hustleman, who has meat in the back of his truck from now on. I can't do that. There is no mutual agency for stockholders. Because the corporation is a separate legal entity, it also has to pay taxes. So that sort of eases into the disadvantages of a corporation. Not only is there taxation, there is also double taxation. In other words, the corporation is taxed on its earnings. And then when the corporation distributes those earnings to the shareholders, those shareholders or owners are then taxed on those earnings. So the government actually gets to take some of that money twice. And there is heavy governmental regulation as it relates to corporations. A lot of different rules to follow, which can sometimes slow down innovation, but definitely needed in more ways than one. So it's sort of a balancing act, but that is a disadvantage of a corporation. So how are corporations managed? Because we're not just necessarily looking at a sole proprietor who makes all the decisions, or two partners where one partner does all the field work and the other partner does all the back office work. We're looking at a collection of a bunch of different individuals. Always keep in mind that the stockholders are the owners. They do have the ultimate control, and they do have certain rights, and we'll talk about that. But one of the rights of the stockholders is to elect or decide who's going to be on the board of directors, who's going to be on the top management team of this business. The board of directors then decides who is the CEO or the president, the vice president of, it could be finance, vice president of marketing, and all of those different divisions, as well as some of those other officers like HR. And then finally, the employees are at the bottom in terms of who is in charge here. Ultimately, it should be for the stockholders. You probably learned in Intro to Business that the number one function of business is to maximize shareholder wealth. And that is because the stockholders are the ones who own the company. Now, I know there's some competing issues. You should be concerned about stakeholders as well, but we're kind of looking at things from the perspective of what the stockholders want, because that is the purpose of the business. So let's look at the rights of stockholders. Stockholders, of course, have the right to vote at those annual meetings that every corporation has. And in those meetings, that's when they decide who's going to be on the board of directors. You know, what direction are we going to go in an overall type of way? Of course, stockholders are not involved in managing the day-to-day operations because they don't have time, but they are involved in electing those individuals who will be making those decisions as far as the day-to-day operations go. Because of the stockholder meetings being located in a bunch of different places, a bunch of different cities, not all stockholders can physically attend, so they are allowed to register or to vote by proxy votes. And that's usually when one of those big corporations will have someone vote on behalf of you. And I'm saying big corporations, one of those big brokerage firms is what I mean. Someone will vote on your behalf because you don't have time to be involved in all those day-to-day decisions, or even you may not even have time to be involved in the right that you have to elect the board of directors. Shareholders also have the right to sell their stock without having to get permission from anyone. They can sell it when they decide that they want to sell it. They have the right to purchase additional shares of stock. They have the right to receive earnings from the company. So when the corporation distributes earnings to its owners, those earnings are called dividends. So a stockholder does have the right to receive dividends if the corporation decides to declare any. And of course, the shareholder has the right to any assets that are left after all the debt is paid if the corporation happens to be liquidated. So each unit of ownership is called a share of stock. We have stockholders, those are the ones who own the stock. So sometimes you'll hear me refer to it as stock or shares of stock or how many shares. I'm talking about one unit of ownership. Here is an example of a stock certificate. Today, all this stuff is increasingly electronic. If you happen to purchase stock yourself, you could purchase stock using Cash App or Robinhood or some of the easier ones to work with. You're probably not going to get an official piece of paper that says you own this many shares. All that stuff is kept track of electronically at this point. But years ago, there was a paper, an official certificate, and on the back of it, when the stock was sold, the stockholder had to sign a transfer endorsement. So let's look at the basics of a corporation's balance sheet. So we still have assets equal liabilities plus equity, but instead of owner's equity, instead of partner's equity, we now have stockholders' equity. There are different types of stock that a company can issue. All types of stock fall into the category of the term capital stock. So throughout this chapter, we're going to see common stock, we're going to see preferred stock, but both of those fall into the category of capital stock. And I want you to keep in mind that stock, again, is just a unit of ownership. So typically, companies will have what's known as common stock, and they'll have a number of shares that are authorized, issued, and outstanding. The number of shares authorized is what is included in the corporation's charter. So when individuals decide that they want to start a business and they want to be incorporated, they have to file paperwork with their local state agency. And usually in that paperwork, there is what's known as an articles or a document called an Articles of Incorporation. And that's also known as the corporation's charter. In that charter, they come up with, and I'm saying they, the individuals who want to start the company, an arbitrary amount. There's no rhyme or reason to it. It's just a really large amount of shares that they will want to issue over the life of the entire company. So this is a really large number. This does not mean this is how many units of ownership they have outstanding. This is what they are authorized to have outstanding. So you pick a really large number because you can't keep going back and revising the charter like, oh, I want 5 shares authorized. Well, no, eventually you're going to have more owners than just 5. So you pick a large number of shares. The number of shares issued and outstanding is the number of shares of stock that we have actually sold to individuals. So see that we have 92 million and some change here in terms of shares. This is not a dollar amount. The dollar amount is based on the par value, which I'll talk to you more about on the next slide. But the par value, again, is another arbitrary amount where when we multiply this amount times the number of shares issued and outstanding, that is the value of the common stock that is in the equity section. Now, there are multiple things listed in this equity section, so it's not just common stock. So I'm going to be adding to that equity section of the balance sheet as we go along. But just make sure you understand the difference between authorized and issued and outstanding. Now, par value, again, in that corporation's charter, when they do that Articles of Incorporation, there is an arbitrary amount that is assigned to each share of stock. This amount is usually really, really low because some states require that par value set something called minimum legal capital. Minimum legal capital is a protection to creditors. This is the minimum amount of money that a creditor could get if a corporation is not able to pay back its debt. So when you look at the balance sheet, and you look at the value of common stock, that number is the minimum legal capital. That is the minimum amount that a creditor could possibly get if the corporation can't pay its debt. So it's not like we're going to fork over that amount in cash. It's just a protection for creditors. Some states don't require you to set a par value. And that's where we'll find different classes of stock, like no par value and stated value. So it really depends on the state that you are dealing with. The market price is what the stock is actually selling for in the open market. If we're talking about stocks that are publicly traded, or even if we're talking about stocks that are privately held, they still have a going rate or a price for it. So the market price is usually not the same as the par value. The par value is the arbitrary amount that we set. We set it, it's pretty much done. Market price constantly changes based on supply and demand, based on economic indicators, based on what the stock market as a whole is doing. So when you are looking at business news, and I hope you're looking at business news, if you're not, you're a business major, you should be. Start looking at business news. I don't care which one you choose, whether it's CNBC, Fox News, I don't care which one you choose, as long as it's some business news. But when you watch business news and they say this stock's price fell, it was 150, now it's 148. They're talking about the market price. That determines how much cash the corporation gets. The par value determines the value of the common stock on the balance sheet. So we're going to see some examples with par value, no par value, and stated value. So when we look at the equity section of the balance sheet, it will include common stock. It will include something called PIK in excess of par. And I'm saying PIK, but actually it's PIC, or paid in capital in excess of par. There are a couple of different names for this. Sometimes it's called contributed capital. Sometimes it's called paid in capital. Sometimes it's called additional paid in capital, or APIC. But whatever we're talking about or whatever term we're using, we're talking about the difference between the par value and the market value. When we combine common stock at its par value and the PIK in excess of par, those two numbers added together will give me paid in capital. So as we look at a balance sheet, I'll make sure I highlight this a little bit more, because this is easier to see on an official balance sheet and not just with words. And then in the equity section, we have retained earnings. So for a partnership and for a sole proprietorship, we learned that in that third closing entry, when we close income summary to the capital accounts, that's how we deal with resetting our books for the next period. In a corporation, there's not one individual capital account for all of our owners. We could have thousands or millions of owners. We can't keep track of each one separately in terms of what's showing up on the balance sheet. So we have a separate account to hold all of the earnings from the business until the time the business starts to the time the business ends. And that account is called retained earnings. This is where we pay our dividends to our shareholders at specific points throughout the period. But the retained earnings account holds all of the earnings and losses of the business from the time the business starts until the time the business ends. So this is an equity type of account. It does have a normal credit balance, so keep that in mind. Let's look at the entry for when a corporation issues stock. And I want to make something clear to you, because in a finance course, we're looking at things from the perspective of, oh, we're investing in the company. But this is not a finance course. This is an accounting course. So we are looking at things from the perspective of the corporation that is issuing the stock. We're trying to do the journal entry for the corporation, not for the investor. So you really have to switch your hat and make sure you know who you are. Because sometimes I'll bring in examples of what's going on in the stock market, and we're used to seeing that from the perspective of investors. But I want you to look at it from the perspective of the corporation itself. And I'm saying that as a disclaimer because when you're looking at business news, most of the time when those stock prices are changing, those market values are changing and people are buying and selling, those are individual transactions that have nothing to do with the corporation itself in terms of journal entries. When a corporation issues new shares of stock in an initial public offering, or when they issue additional shares of stock, then there's a journal entry to be done. But if I decide that I want to go and purchase shares of stock of McDonald's, and I hate McDonald's, I don't know why I keep using McDonald's, but if you like McDonald's, maybe that's why I'm using it, because there's somebody watching this lecture that likes McDonald's. But if I decide that I want to be an owner in McDonald's and I buy shares of stock, I'm not buying that directly from McDonald's if McDonald's hasn't issued any additional shares of stock. I'm buying that from a current stockholder who's willing to sell it to me. So in that situation, there's no journal entry to be done. In this situation, the corporation is issuing shares of stock. So let's see what happens. On June 5th, Dillon Snowboards issues 30,000 shares of $10 par value stock for $300,000. When a corporation issues stock, they receive cash. This is the way the corporation raises money. You can either raise money by issuing stock or borrowing money. And when we're issuing stock, all we're doing is getting new owners. And when those owners come into our business, remember, they bring in assets. So we debit cash and we credit common stock, comma, $10 par value. Now, I'm not nitpicky on the comma $10 par value. I am nitpicky on the term common stock because there are different types of stock. It could be preferred stock. So make sure you're putting common stock. Because this stock was issued at par, in other words, the amount of cash we received was equal to the par value of this stock. This is all I have to do in this entry. So in this case, the market value is equal to the par value. Keep in mind the par value was 10. The market value determines how much cash we receive. Now let's see a better example. On June 5th, we have the same company. They're still issuing 30,000 shares of $10 par value stock, but the market price is not $10. The market price is $12 per share. Keep in mind that the market price determines how much cash we receive. So to find out how much cash we receive, we take that market price of 12 and we multiply it times the 30,000 shares and we debit cash. Common stock is valued at par. When we are issuing par value stock, common stock is always valued at par. That's my minimum legal capital here. So I have to use the $10 and multiply it times the 30,000 shares, and that gives me the value of common stock. Now, if that's all I do, debit cash and credit common stock, my entry doesn't balance. I'm off by 60,000. And that is because I need to keep track of the difference between the market value and the par value. We keep track of that by using that PIK in excess of par account. That's what I was talking about. Paid in capital in excess of par. Again, I'm nitpicky on this one. I prefer that you put comma common stock if I'm dealing with preferred stock as well. I don't mind you abbreviating, and the abbreviation does need to be PIC in excess of par value. Some textbooks, some companies will use the term additional paid in capital or APIC. So if you decide to abbreviate it as APIC, I will accept that as well. But when you see me do problems, I'm typically going to use PIC in excess of par. This is also an equity account. It does have a normal credit balance, and it's sort of my plug figure to make sure that my journal entry balances. It is the difference between the cash proceeds and the par value of the common stock. So here it is on the balance sheet, and that's what I wanted to show you. If I combine common stock at par value and paid in capital in excess of par, those two numbers together will represent paid in capital. This down here, I know it says paid in capital, but it's paid in capital in excess of par. It's what's more than the par value. Notice that for common stock, there are 50,000 shares authorized, but we only issued 30,000 of those 50,000 shares. What happens to the other 20? Nothing. It's just kind of sitting there until we decide that we want to issue more shares of stock. But we multiply that 30,000 shares times that $10 par value to determine the dollar figure. Paid in capital in excess of par was the difference between the par value and the cash proceeds or the market value. And then retained earnings, that's where we were closing our income summary to our capital account. But this is the capital account we use, retained earnings. So lots of new things in the equity section here. Now let's look at no par value stock. With no par value stock, the journal entry is fairly easy. And I hate to use the term easy because easy is such a subjective term. And I'm only saying it's easy because all you have to do is debit cash, credit common stock. Because there is no par value. There is no minimum legal capital. Why do companies want to issue no par value stock? Well, they don't want to offer that protection to creditors. They don't want creditors to look at their balance sheet and say, hey, what's the minimum amount that I can get? What's my protection here? And in some states, they are allowed to do that. So they will have no par value stock. So we credit common stock, common no par value, and we debit cash. For stated value, again, we don't want to offer that protection. And sometimes in dealing with par values, if par values are not low enough, you can inadvertently cause a liability, again, which is way beyond the scope of what you guys need to know. I can talk about this all day in terms of the theoretical concepts and why we have par value. Don't worry about that. Just know that some companies will issue stated value stock. If you're interested in that, then possibly you should be an accounting major because we'll definitely talk about that in intermediate 2 in more detail. But for now, for stated value, we treat the stated value as if it is par value. In other words, common stock is now valued at the stated value. And instead of PIK in excess of par, we have PIK in excess of stated value. So in this example, the corporation issued 1,000 shares of $40 stated value stock for $50 per share. The $50 per share is the market value. It determines how much cash we receive. The $40 is the par value. It determines, the stated value. It determines the value of my common stock. Because those two numbers don't agree, I have some PIK in excess of stated value. Now, the same way owners can come into a business by bringing in assets and liabilities, it can happen this way for a corporation as well. In this example, we see that the corporation has accepted land. The value of the land is, of course, the market value, and it helps us determine whether or not there is any PIK in excess of par. Notice that the par value was $20, but the market, and it's $20 times 4,000 shares. That's where we get that 80,000 from. That is not equal to the market value. So we do have to subtract those two numbers to find our PIK in excess of par. Sometimes corporations, when they are issuing shares of stock and they're just starting, in order to pay their promoters, they may not have a ton of cash. They will pay their promoters in shares of stock. When that happens, instead of debiting cash, we debit organization expenses because we're compensating them for their work, but we're using shares of stock as compensation. That's a beautiful thing about stock. It can be used in so many different ways. Yes, we as the corporation can use it to raise money, but we can use it to pay our employees. We can use it as a form of payment for work that needs to be done for us. Stock is a wonderful thing. So let's continue with this in the next video, where we'll take some more time and we'll look at transactions involving dividends, whether it's cash dividend, stock dividend, or stock splits. I appreciate your time and attention, and I hope you have a wonderful day.